Okay, so it's just gone 11 o'clock by my watch, so we will make a start. Hopefully everybody can see my screen, if not, and hear my audio. If not, just pop a question in the Q&A and we'll see what we can do to fix that up. My name is Bevan Pierce. I work at Grow Accounting along with Tasha Hungerford, and today we will be co-hosting this webinar. I'll be doing most of the speaking unless Tash has something important to jump in and say, in which case you may have an interjection. It's the first time I've run this webinar, so we might just have a couple of teething problems, but hopefully we'll be all right. And there's 2 or 3 core concepts that will come out through it that I would like you to take away today and integrate into your own business. So first of all, it's not advice. This is just general information. Nothing that we show you or talk about today is really going to be able to be taken away and relied upon. And one of the core concepts of my entire advisory career really is stressing to clients to take advice, take professional advice. Don't be that client that says, I like what you're saying, but, because one thing that defines those that are successful in business and those that perhaps aren't as successful is the ability to surround themselves with people that have skills and expertise that they don't, and they can rely on those and leverage off those. So definitely take that advice. If you find you're thinking about doing your own legal documents or your own tax returns and things, really question yourself, because it can be a barrier to your success. The presentation itself today is going to provide a general framework upon which you can build for your business. We're not going to focus a whole lot on the actual financial modeling side, which might surprise some of you. The reason why we're not doing that is because there are so many tools available, and the financial side of it is only one part of the bigger picture for your business success and your planning for success. So hopefully from today you'll have something to think about and apply to your own business. And if we can achieve that, then that's going to be good. So who are we? We are Grow Accounting. We're a Sunshine-based accounting firm. We have clients across Australia and across the world. We rely on technology to deliver our services to our clients that aren't local. But if you are local to the Sunshine Coast, then by all means call in, say hello, and we can have a cup of coffee. We work on fixed fees, and we include as much of this proactive planning type work for our clients as we can within that fixed fee. So our clients may pay no more for their BAS returns than people at other accounting firms, but we provide them with a comprehensive management report for no charge every time we do the BAS return. So it creates that value around that planning information and really having control of your business. So one of the stories that I'll come back to throughout this presentation is about travel and going on a trip. So when you're a pilot, you're taking your plane up into the air with a bunch of passengers from Brisbane Airport. Not only do you know where you're leaving from, you know where your destination is, and you have a route mapped out to get there that's roughly the route you want to progress along. It's not necessarily going to be the exact route, because as in business, things change. And when things change, we need to be responsive enough to actually deal with those changes, which means 2 things. First of all, we have to have some systems or processes in place to identify that things have changed within a time frame that allows us to respond appropriately. And second of all, we've got to be able to respond. So we've got to build that flexibility into our business. So coming back to the actual planning process, we're gonna look backwards and see what information we've got from the past in our business and how we can incorporate that into the future to make better decisions, which ultimately is going to give us control of our business. So we're not a coconut floating on the waves, just landing at whichever island we decide to make landfall on. We're actually driving that coconut, if we could, on the waves, and we're heading towards the island that we actually want to be landing on. So that comes down to exit strategy and our own personal objectives, and we'll touch a little bit on those later on. So the basic process of planning for your business, well, it really starts with knowing where you want to go. So you've got to figure out what it is you want to achieve from your business, and then you work backwards to make a plan to reach that destination, okay? Consider last time you planned your holiday, probably the first thing you thought about was where you wanted to go, okay? Now, Vanuatu, we may wish to go to Vanuatu on a holiday. So we make that decision, and then we work backwards to put all the steps in place so that we arrive at Vanuatu when we want to and in a state that we want to. And it's no different than business. So business, you may, if you look at the departure board here, you may want to end up filthy rich. Well, that's cool, but that flight's been cancelled today. We do have a second income objective down the bottom, business sale, passive income, bankruptcies most certainly being cancelled, or we may have a profit objective, $200,000 objective. So to establish your starting position is the beginning of the ending position is the beginning of everything, because if we don't know where we want to end up, then where we end up ultimately will be a function of luck. And I'd rather be in control of my destination and where I'm going to than simply rely on luck to get somewhere as yet unknown. Once we have our starting position, our ending position, we then establish our starting position. Because if we know we're going to Vanuatu, unless we know that we're in Brisbane at the moment, really we have no idea which direction to start travelling in to reach our intended destination. So the starting position is where we're looking at the history of our business, we're looking at our balance sheet, and anybody that attended the webinar yesterday will understand some of the intricacies of the financial statements. And we're looking at those things to set a benchmark from our trading statement for how we can amend our business to achieve the results we want. And our balance sheet ultimately is going to record the value that we're building in our business, but also our capital and our access to capital. So once you've got your starting position somewhere over near Perth and you've got your ending position clearly in Queensland, you can map your route. Now this is with a crystal ball, the best route that we think we're going to be traveling to get to our intended destination. Like I said before, things will change on the route. There's one thing for certain in the planning process, you will not get it right. Things will change and you've got to be responsive to that change. Once you have your route mapped out, we're then going to check in on your milestones. You've got a few milestones along here. Now, on this particular example, we can see that we were traveling from Perth pretty well towards the east like we wanted to. And then we sort of started heading up towards Darwin. Now, if we didn't realise that we were heading in the wrong direction, we might have merely kept driving out into the Western Australian desert, and who knows what could have happened then. But at some point, we had the processes in place to check that we were in where we were. And with those processes, we managed to amend what we were doing in our business and get back on track and start to head south and back towards that Great Australian Bight. So in business, it's no different. We need to have the systems in place that tell us where we are, where we're headed, and we need to have the responsiveness in place that allow us to modify what we're doing to get back to where we want to go, Or alternatively, a perfectly acceptable outcome is to actually change our destination. So if we start heading towards the middle of the Western Australian desert and we decide that that's actually pretty good gold grounds, then we might want to keep heading there. So don't be afraid to change your destination along the way either. Once we've done that, we then do it all again, because our new position that we discover from our existing reporting is our new starting position. And then we map our route again, we check in on our milestones, and we do it again, and we do it again, and we do it again. Now, whether we do that weekly, monthly, or quarterly is really up to you guys, and it'll be determined by the scale of your business to some extent. But monthly is ideal. Quarterly is okay for smaller businesses. Weekly, well, you might want to monitor your cash weekly if cash is a concern in your business, as it generally always is. But if you're monitoring your business financials weekly, then quite often those timing differences that flick across 1 or 2 or 3 days will have a significant impact. So just bear that in mind if you're building a weekly reporting system. What do you want to achieve? This is important. Wealth is always usually number one for business. So I'm going to rely on the assumption that we're all here to build some wealth. Even if we're running a not-for-profit, we still want to generate income to achieve our objectives, and we can proxy that with wealth. Wealth being the difference between wealth and income being that wealth is the portion of income that you're going to store away for later on, whereas income is just income that allows you to achieve your objectives. Lifestyle is important. If you want to supplement your existing income with a second wage, maybe monetize a hobby, do you want to earn a wage equivalent? So you just want to get out of working for the man and work for yourself. Do you want to earn a higher income? So do you want to grow that business? Income is really important, and a lot of our planning works from income. Starts and is driven off income because it's our capacity and our ability to generate income that drives a whole lot of the activity in our business. Okay. Lifestyle is about hours we work, whether we want to work remotely, whether we want the business to operate remotely. So I had a client who for 2 or 3 years in a row came in to see me about his business. He ran a mechanics business and he was working 80 hours a week, earning, say, around $40,000 a year. Every year, his request to me was, how do I reduce my hours? He was concerned he didn't have enough family time and he was working too long for the income he was earning. My answer to him every year was increase your prices. He was reluctant to do that because he thought that increasing his prices, he'd lose half his business. Well, that was really the point of it, really. That was the point of my advice. But by understanding your financial model, or his financial model as I did, I could show him that even though he would lose half of his business, the reduction in his income would be relatively insignificant. So if he was to increase his prices using some modeling based on his historic performance by 20%, he would lose 40% of his business, but his profits would only drop by, say, $5,000. So we could pick that $5,000 up in many other ways inside his business by making some changes. But he was scared about increasing his prices and losing half his business because he thought that meant losing half the profits. That's not always the case. And understanding our financial model is critical to planning for the future. And as we go along, every cycle we run through the planning cycle, we will understand our model more and more. Okay. Exit strategy. Now, exit strategy is important. Exit strategy is important because if you have a desire to build a business to sell, you need to set that business up to sell. And sometimes the objectives to set a business up to sell compete with the objectives of generating income and particularly tax strategies. But you need to balance that off over the ultimate objective, which is selling. And selling a business, you're going to generate a lot more wealth than earning another $20,000, $30,000, $40,000 a year for a couple of years, generally speaking. Okay. Maybe you just want to continue to earn a passive income. So we need to set up systems and procedures in the business. All of these things cost money, and all of these things need to be planned. All right. This process that we're going to go through will give you a framework to build that planning upon. So mapping your route and your metrics. I might just shoot back, and from this place, we can just do a poll here. I just want to get an idea about the scale of the businesses and the people that are here today. So if I run a current poll, it'll be very quickly a question: do you have business plans or budgets or forecasts in place? And then we might follow that up with, let's see how we go. Let's run this one. If you can just answer this question, whether you have business plans, budgets or forecasts in place for your business. Okay, just a few more seconds to pick up the stragglers who may or may not wish to vote. Okay, all right, that's good. Now the results there show something that is not unsurprising to me. Half of participants today don't have any business planning or budgets in place or forecasts. It makes it really difficult to manage your business and achieve what you want to achieve and arrive at the destination you want to arrive with your business without those in place. So hopefully today will inspire you to move on with some planning, get some advice and build it. And we'll see from today, it doesn't have to be expensive and it doesn't have to be a very complicated process. It can be quite simple. So mapping your route and metrics. So assuming we all have an idea about where we're at, we're going to have a look at what we have to do to map our route and metrics. Now, I will say something here. You will never get this right. It will always, always change. So this will be the biggest job you'll never get right. We can use our crystal ball as much as we like, but we need to be responsive to change. And we also need to have systems in place that tell us when things aren't quite heading in the right direction. Okay, so from the startup position that we're at, heading towards our vision of success, okay, we're going to work. Sales generally is going to be the one that determines the growth in our business. Generally, always growth is measured by sales. From that, we're going to drive some costs. So what costs are going to be driven by those increases in sales? And what we're going to look at is we're actually going to look at activities on a behavioral level. So people think that budgeting and forecasting for a business is about dollars and cents. Well, I disagree with that. Budgeting and forecasting for business is about behavior. It's about getting people and ourselves to do the things that we need them to do to achieve the objectives that we want. Now, sure, there's a financial impact to it, and finances and dollars are things that we can measure the success of our planning, but really, planning is about behavior. It's about making sure that everybody within our business is working all the time to achieve what we want to achieve and documenting that plan so that there is a cohesive link between the actions we do on a day-to-day basis and what we want to achieve in terms of a long-term vision. So we'll talk about developing your high-level vision. We'll talk about how that links with your strategic objectives and how that drills down to your operational objectives. Now, those operational objectives are behavioural, and that's what becomes our KPIs, and that's what we're going to measure in the first instance. So we'll run through a couple of examples about that you can apply in your own business. If your objective is growth, then we want to know how much capital you have access to. growing a business, particularly a trading business, sometimes drains a whole lot of cash, because often the cash cycle, turning that dollar from a sale into a dollar into your bank, takes longer than the cash cycle to pay for those costs. So you may have to pay my wages every week, but the money that you're going to get from the customers that I'm working on might not come in until next month, or in some cases 2 months or 3 months down the track. So it's really important that you have access to capital to see you through those periods. And that comes back to understanding your business model and how your business churns through cash. Additional plant and equipment, how are you going to finance it? How are you going to get access to that finance? Do you need additional premises, for instance? If you're retail, are you going to open another shop? If you're a warehouse, do you need another warehouse or extra storage space? At which time do those big chunks of fixed costs come in, and how are you going to fund them so that your business doesn't grind to a halt financially? Okay, so ultimately what we want to develop is a business plan that integrates that vision that you have for your business, so sitting on a Queensland beach, as this one may be, with how are we going to do that? So how many phone calls are we going to make, cold calls? How are we going to increase sales? And the important thing about expressing those is that those behavioural levels, those operational levels, become your KPIs, and they have to be smart. So you may have heard previously about SMART objectives. Now, SMART objectives allow us to specify what it is that we want to do. They're measurable, so we can work out whether or not we're doing them enough. Okay, they have to be achievable and realistic, because if you've ever tried to get a horse up into a canter to chase a carrot, if the carrot's a kilometre down the road, the horse is unlikely to move, right? But if the carrot's right in front of his nose, then he might just make a bit of an effort to get to it. So they have to be achievable and realistic, and they have to be time framed. Okay? So in terms of a general KPI and objective, we need to make sure that these are communicated in a way that is really clear, that we can measure them, and then we compare them to the responses and the outcomes that we achieve. And hopefully, if it all lines up, then we're doing pretty well. If it doesn't, then we need to change something. I'm going to make another statement now that's maybe different to what people have heard previously when they've considered planning. There's only 2 reasons ever there is a variance between our plan and our outcomes. Okay, so we might plan to increase sales by 20% and we only increase by 5%. There's only 2 reasons ever. So if we simplify it down to that, there's only 2 things we need to improve or change to achieve a better result during our next reporting cycle. The first reason is that we got our budget wrong. Almost always it's correct. So we might budget, for instance, our objective might be to increase wholesale sales by 20% by the 31st of December 19. That's a SMART objective. And the way we might do that is by making 10 cold calls a week. Now, history tells us that we convert 1 in 10 cold calls into new business. And we know that 1 new client a week is going to achieve that 20% sales. All right. So using this specific KPI as an example, the operational level was to make that 10 cold calls a week. Now, if we report on our results and our results aren't an increase in 20%, then the only way that could possibly have happened is if we didn't make 10 cold calls a week, which is what we plan to do, or if the results from making those 10 cold calls were different than what we thought. And that's understanding your business model. So we might have thought we converted 1 in 10 to a new customer, but the reality is we convert 1 in 20 to a new customer. So we then have the option, once we understand that information, of feeding it back into our next cycle budget and saying, well, we're going to make 20 cold calls a week because we really want 1 new customer a week. Or the alternative is we're going to change our strategic objective to increase wholesale sales by 10% because we're going to continue to make 10 calls a week, and we know we're only going to win half a customer a week out of those 10 calls. So our wholesale sales improvement's going to go down by half. Okay, do you follow what I'm saying? There's only ever 2 reasons for a variance. Okay, and one of them will allow us to learn about our business model and maybe amend our operational objectives, and the other will allow us to change what we actually do or what we want to achieve out of those operational objectives. So that's the real power of this approach. So we've spoken about Jenny's chocolates. Now, Jenny has a vision to increase wholesale sales by 20% by the 31st of December. That's her strategic, okay? Her vision is to grow a business, okay? Her strategic is to increase wholesale sales, and her operational, which is the how, is to make 10 cold calls a week, attend 2 trade fairs a year, and do a brochure drop. That's how she's going to meet her strategic objective of increasing wholesale sales by 20% by 31st of December 19, and how she's going to meet her vision for her business, which is to grow it, okay? We can then connect everything we do on a daily basis with the vision for the business for Jenny, which is to grow the business. So at any point in our business activities, we can question ourselves and ask ourselves, is what we're doing going to achieve what we want to achieve, which is the vision, expressed as the vision, okay? So I had a client who was in a sales business, and he didn't like sales. He wasn't good at cold calling, so he didn't do it. Quite often he'd be out in the workshop and he'd be sweeping the floor or building new shelves and things, and he'd be doing all of that. But none of that was achieving his sales objectives. So I got him to stop almost hourly on the hour and ask himself, am I doing right what I'm doing right now? Is it contributing to the goals that I've written down on my business plan? All right. And if the answer to that question for him was no, then he needed to either change his business plan so that it was, or he needed to change what he was doing so that what he was doing was in line with his business plan. See, only 2 options. There's only 2 reasons ever for a variance. And it's fair enough. If you don't like making cold calls, get some resources in your business that allow that to happen. Okay, it's going to drive extra costs, but we're going to filter that in through our business and our financial plan so that we make sure if we're not the ones doing cold calls, we've got someone in there that actually is. And then over time, we're going to monitor how effective they are at it, and we're going to amend our relationship between the number of calls we make and the increase in sales, okay? So that's just one example of how we can take our vision for the business, which is to grow it, work it into a plan for things that we're going to do in the future and exactly how we're going to do it, okay? So writing it down is really important. And what we've got in a lot of cases is people telling you you need a 30-page, 40-page business plan, and you've got to have a comprehensive financial budget and model. I don't disagree with the financial budget and model, by the way, and make sure that if you do have a financial budget and model, that it's fully integrated with a profit and loss balance sheet and the missing link, which is a cash flow forecast. Because businesses can be growing, they can have great equity on their balance sheet, but if they run out of cash, they die. So cash is king in business. So you've got to make sure that when you put your measurement systems in place, that you include that integrated cash flow forecast with your financial model, okay? Plenty of tools around for it. It doesn't have to be expensive. Coming back to the writing it down, I like to keep things as simple as possible. I am a Kiwi. If it's not simple, I can't understand it myself. And if I can't understand it myself, then it's highly likely that my clients won't be able to understand it when I explain it to them. So a business plan could be as simple as this page you've got on screen now. It outlines your vision, which is to grow the business. The strategic objectives are the what. What are the things that you're going to measure your results by that tell you that you're on track and heading in the right direction, right? Increasing wholesale sales by 20% for Jenny, all right, and establishing a new shop to be opened by the 26th of May 2019, all right? How is she going to do that? So this is important. How is she going to do that? And the increasing sales we've already been through, and the opening a new shop, well, there's two things she has to do to achieve that objective. She's got to open the new shop, and driven from that might be 20 other tasks, right? And she's got to organise new staff training in the shop. So the when is important because we need to know the when, and the who is important. So if you take nothing else out of this presentation today, then take away this one sheet and use it to work out exactly how you're going to achieve from your business what you want to achieve. Once you've done this, we can then overlay the financials. Okay, we know what it is that you're going to do. We can work out how you're going to do it, and we can work out how much that's going to cost, how you're going to get the funding, and so on and so on and so on. So this is the first step that the business plan has to have, and write it down. If it's not written down, it's not written down, but it's out of our consciousness. So we overlay the financials. So we know what we're going to achieve. We know what we're going to do. We know when we're going to do it. We've done all of our research on our financial and our costings. And now we're gonna start to get into the dollars and cents. This is where there are some really good tools available. And like I said, I'm not really going to go into it in any detail other than a conceptual level, okay? The core messages I want to communicate here are that you build your budget from the bottom up. So you start with the things that you want to achieve, you drill down into those with the how you're going to do it, and then you work out how those things are going to be represented in increased sales or outputs, and how much those things are going to cost and when, and you plug that information into your budget. Now, that is the only way to build a robust budget for your business. And the alternative is that you start with a figure at the end and you just go and change things and try and work your behaviours in and your costs in to meet the things that you change. You know, it doesn't really work that way with the financials. And if you get to the end of the process of building it up from the ground up, and the result you have projected in terms of financials, in this case $160,000 profit, isn't what you want or need, then you go back to the beginning and you change your behaviours. They change your output and your results, and they change your costs. And it's an iterative process where you go back and forward and around and around and around until you reach the outcome that you want to achieve, or until you change the outcome so that it's a realistic outcome for what you're actually going to do. Okay, in terms of the budget itself, this is basically a monthly profit and loss statement, and you can see from the past for Jenny's chocolates, we know that her purchases may be running at 55% of sales. So we know if we're going to drive off a sales budget and a sales target, what our purchase costs are going to be. We can work out ratios for things like bank fees, for things like office expenses, and we can drive those calculations off fundamental underlying drivers of those costs rather than just plonking willy-nilly, this is how much I want to spend. We say, well, we know, for instance, that when we open our new shop, as we're going to in May, we're going to have to pay increased rent. So in the purple down here, you can see that the rent is starting to come through. Now, Jenny's negotiated a couple of months rent-free, as is pretty standard. So we're putting the rent through here from July, even though the shop's going to open in May. We know that our insurances are going to go up. We know that our wage costs are going to go up. Now, they're going to go up before we open the shop because we have to bring staff on and train them. So all of these costs that are filtered into this financial budget are costs that are driven from what we're actually going to do, as opposed to working out what we're going to do from the costs. Okay? So, and this is important. Each of these elements in our budget, purchases, wages, how do the wages affect our cash budget? So we know that we're going to incur wages of $1,000 this week, but the PAYG on that isn't going to be paid to the tax office until, what are we in? We're in May still? May, June, July, or August if you have a tax accountant, okay? So we need to make sure that we budget the cash output or the cash cost for that in July, even though on a profit and loss basis, we're budgeting the cost now because now is when we incur it. So those of you that attended Tash's financial statements webinar yesterday will understand the difference between cash and non-cash. Okay, so even though on the profit and loss we recognise an expense today, we might not pay it for, in this case, 2 or 3 months. All right, and the opposite is also true. We may pay a deposit for equipment right now, but we may not get that equipment for 2 or 3 months. So you need to be realistic about those cash flow timings. And the tools that are available to you and your accountant these days are really good for working those things out. So early on in the presentation, I said, don't be the client that says, thanks for your advice, but, okay, really don't be overly focused on costs of professional advisors or any advisors, whether that's marketing, whether that's HR, whether that's accounting, tax, or law. Be aware more of the value that they're providing to your business. And as long as those costs are incorporated into your business plan and affordable, then you should be going for it. Not the fact that you have to pay a lawyer $600 an hour to draft a contract up shouldn't detract you from paying that money if the benefit of that contract is going to be $5,000 or $10,000. So don't focus on cost and cost alone. Yes, cost is important for managing your profitability, and yes, savings and costs are a way to quickly improve a business that's perhaps running at a loss at the moment, because every dollar you save in a cost is a dollar added to your bottom line, as opposed to increasing sales, where every dollar you add in sales might only add 15 cents to your bottom line, depending on how efficient your business is at turning that sales revenue into profit, okay? So I just want to recap a little bit about what we've said and put some of what we've covered today into some sort of context so you can take it away for your business and your business to ultimately be better for this knowledge. So the key things that we want you to take away today, in my view, is that budgeting is about behavior and control over your behavior and other people's behavior to achieve the outcomes you desire, okay? It all comes back to what you want to achieve out of your business. Once we start that and we specify that, we then work out the how. There are only 2 reasons for a variance. Either we didn't do what we thought we were going to do, or we did do what we thought we were going to do, but the result was different. The first one's easy. Change what you do. So if you're sweeping the warehouse floor, instead of making cold calls, jump on the phone and start making cold calls, all right? For the second one, over time doing this process, you'll come to learn your business, understand your business model more and more, and so you'll get better at projecting how what you are going to do is going to translate into sales or into the outputs you want to achieve. And in our example, how making cold calls is going to translate into higher revenues, okay? And that relates to conversion. But it's about using our past best information to project future. And remember, today is only tomorrow's past information, okay? So today is tomorrow's history. So what we do today influences the picture we get of our business when we look back at the historical financials. What we want to achieve is we want that picture to be exactly what we want. So we want to make sure that what we do today influences it in a positive way. So history can guide your future projections. Understand your drivers of revenue and drivers of cost and make your calculations based on those. Don't start with a figure and try and work backwards. It can work in some situations, but not in any significant business enterprise. Starting with what you want to achieve and then how you're going to achieve it, what that's going to cost, what that's going to deliver in terms of revenue. And then if you get to a result out of that that's not something that's acceptable to you, go back and change what you want to achieve. Don't just change the numbers to make it fit. Okay. Be flexible, be willing to change and learn from every review. Okay, so today is tomorrow's history. We know that every time we go through the cycle, we should be learning something more about how our business converts that $1 in sales into 15 or 20 cents in profit. We should be learning a little bit more about when we do something, how that affects our outputs and our outcomes and our results. Okay? If your results are not what you wanted, then change what you do. The alternative is to change what you want, which is perfectly acceptable as well, but change what you do if the what you want hasn't changed, okay? Because it's what you do and what the people in your business do that ultimately gives you that control and gives you the results that you are really looking for in your business. And then finally, just do it again and again and again and again. So you're on a treadmill, that's what it is. And that's what business is to some extent. So I'm pretty much finished now. What I'm going to do is hang around for 15 minutes for further questions. I think Tash has answered some questions as we go. If we don't answer your question, then we will get back to you on the response. It may just not be this morning. A copy of the video of this presentation will be available through our YouTube channel, and that'll be sent out along with the slides over the next few days. For more information, the business.gov.au website has a lot of information on it that's really valuable. Right? I do want to stress, though, one of my core messages to all my clients and potential clients: business is tough. Be prepared for it to be tough, be open for advice, and be prepared to work hard. If you do that, then your results are in your own hands, and it's up to you to go ahead and forge your version of success. So thank you very much. I will mute the presentation now, and we'll deal with some of those questions through the question and answer panel, please, as opposed to the chat one. Thank you. Bye-bye.